All right, let's jump right in. Have you ever stared at a financial chart and it just looks like a bunch of chaotic, unpredictable squiggles? Well, what if I told you there's a hidden logic to it all, a code behind the price movements? Today, we're going to try and unlock that code using something called the Wyckoff Methodology.
I mean, it's a feeling we've all had, right? That the market swings are just totally random, bouncing around based on the latest news headline or some emotional panic. But what if that's not really the whole story? What if there's a game being played, with rules that most of us just don't know? You know, this was the core belief of a guy named Richard Wyckoff, who was a real pioneer of market analysis way back in the early 1900s. He basically said, forget the noise. The market tells you everything you need to know through its own actions, through price and volume. If you can learn to read that story, you can start to figure out what the biggest players are planning.
So here's how we're going to break it down. First, we'll get into the whole idea of the hidden game. Then we'll walk through the 4 repeating phases of the market cycle. After that, we'll cover the 3 fundamental laws that make it all tick. We'll look at how to spot the most critical moments, and finally, how this whole thing can totally shift your perspective. So what exactly is this hidden game? Well, it all starts with a pretty radical shift in how you think about the market itself.
So on one hand, you have the public view. The market is just reacting to news and what everyone else is doing. But the Wyckoff view, it's completely different. He saw the market as a game, one that's carefully orchestrated by large professional traders, what he called the composite operator, or as we'd say today, smart money. And their goal is incredibly simple: buy low from the public and then sell high to the public.
And listen, Wyckoff was in a position to know. This guy was a total Wall Street insider. He started as a stockbroker at just 15 years old. By the time he was 25, he owned his own firm. He had a front row seat watching exactly how the big dogs move the market for their own profit. So he made it his mission to teach regular people, the public, the real rules of the game he was seeing every day.
Okay, so how do these big operators actually move the market? Well, Wyckoff saw that they follow a repeating blueprint, a 4-phase cycle that is the absolute heart and soul of his entire method. And this cycle, it unfolds in a really logical way. It all starts with accumulation. This is where the smart money is quietly buying up everything when nobody else wants it, when the news is bad. Then, once they've got what they need, they start the markup. That's the uptrend. After that comes distribution, where they start selling off their holdings at high prices to all the excited buyers. And finally, once they've sold, they just let the price fall in the markdown phase. And that's where the whole cycle can start all over again.
Now here's the really mind-blowing part. This isn't just some big long-term pattern you see over years. This cycle is fractal. That means you can see this exact same 4-phase pattern playing out on a 5-minute chart, a daily chart, and a weekly chart, often all at the same time. It's everywhere.
All right, so what's actually driving this cycle? What makes it go? Wyckoff boiled it all down to 3 basic laws. I like to think of them as the physics of the market.
And trust me, they're a lot simpler than you might think.
Just 3 of them. Law number 1 is the engine behind pretty much any market: supply and demand. It's simple. When there are more aggressive buyers than sellers, prices have to go up to find people willing to sell, right? It's like the last hot toy before the holidays. Tons of demand, very little supply, and the price just skyrockets. And of course, the exact opposite is true when sellers are in charge.
Now, law number 2 is cause and effect. This one tells us that those boring sideways markets actually have a hidden purpose. Think of it like coiling a spring. The longer that market grinds sideways, building a cause, the more energy it's storing up. So when that energy is finally released, the trend that follows, the effect, is going to be that much more powerful.
And law number 3, effort versus result. This is our reality check. The effort is the trading volume. How much work is being put in? The result is what the price actually does. So imagine you're pushing a car with all your might. That's a lot of effort, but the car isn't budging. That's a poor result. You know something is wrong. It's the same in the market. If you see huge volume but the price is barely moving, that's a divergence. It's a huge warning sign that the trend might be running out of gas.
Okay, so now let's use these laws to spot the 2 most important phases of them all: accumulation and distribution. This is really where the smart money is either buying from people who are scared or selling to people who are greedy.
Let's just put these 2 side by side. During accumulation, the goal is simple: buy low. This usually happens when the news is terrible and everyone's pessimistic. You'll often see volume dry up as all the available shares get absorbed. And a key event to look for is something Wyckoff called the spring. It's a final sharp drop below a key support level. It's designed to scare out the very last sellers right before the real move up. Now, distribution is the mirror image. The goal is to sell high when the news is amazing and everyone's euphoric. And the key event here is the upthrust, a final spike above resistance that's designed to trap the very last eager buyers right before the price collapses.
So when you put all of this together, what does the Wyckoff method really give you? Well, it's not just a set of rules. It's about a complete and total shift in your mindset.
What you get is a framework to see the market's true trend, so you can trade with it instead of constantly fighting it. You learn how to actually gauge the strength of buyers versus sellers by watching price and volume work together. And most importantly, you stop gambling and you start interpreting a logical story that's being told, right there on the chart.
And really, this is the biggest takeaway. The Wyckoff method is not a crystal ball. It's not about predicting the future with 100% certainty, because nobody can do that. It's about analyzing the evidence on the chart to put the probabilities in your favor, to align yourself with the powerful force of the smart money. So I'll just leave you with this question to think about. The next time you pull up a chart, are you going to see just a random mess of jagged lines? Or are you going to start seeing the phases, the laws at play, and the story of accumulation and distribution just waiting for you to read it?